Last episode, we covered market structure, why FX is over the counter, why it operates 24 hours, why the dollar sits at the center of everything. Today, we're looking at who's actually in this market. Because here's the thing about foreign exchange. It's not just one market. It's multiple markets operating simultaneously with different participants pursuing different objectives. Understanding who's doing what and why makes you a better practitioner. It helps you read flows. It helps you anticipate price moves. It helps you avoid being on the wrong side of someone else's strategy. We're going to walk through the major participants: banks, corporates, asset managers and hedge funds, central banks. Not just what they are, but what they're trying to achieve and how that affects the market. Let's start with the banks, because they're the foundation of everything else. Banks are the core of the FX market. They're the market makers, the liquidity providers, the counterparties for almost every transaction. But not all banks operate the same way, and understanding the distinctions matters. First, there's the interbank market. This is where banks trade with each other. In my day, this happened on Reuters and later Bloomberg screens. You'd see prices streaming from other banks. If you wanted a deal, you'd hit the bid or lift the offer. Today, it's mostly algorithmic, but the principle is the same. The interbank market is tiered. At the top, you have the major dealers: JP Morgan, Citigroup, Deutsche Bank, Barclays, UBS. These banks make prices to everyone. They have massive balance sheets, global operations, sophisticated trading desks. They see order flow from corporates, hedge funds, central banks. That flow is information, and information is valuable. Below them, you have regional banks and smaller dealers. They make markets to their clients, but often hedge in the interbank market with the major dealers. And below that, you have banks that don't make markets at all. They're just taking prices from others. Where you sit in that hierarchy affects the price you get. If you're a major corporate dealing directly with a tier 1 bank, you'll get competitive pricing. If you're a smaller company going through a regional bank that's hedging with a major dealer, you're paying a spread on a spread. This isn't theory, it's how the market actually works. Now, how do banks make money in FX? 3 ways. First, the bid-offer spread. When I quote you 1.3250 to 55 on euro-dollar, I'm buying at 50 and selling at 55. That 5 pip spread is my edge. Do enough volume, those pips add up. Second, they position the book. If I think the euro is going higher and I've got natural sellers, corporates hedging euro receivables, I might hold some of that flow rather than immediately hedging it out. If I'm right, I make money. If I'm wrong, I lose. That's proprietary risk. Third, they use their flow information. Not front running, which is illegal, but understanding that if I'm seeing heavy corporate demand for dollars against yen, that tells me something about where the market might be going. Flow is data. Good traders read it. When I was running the Real book in Saudi, we were small compared to the global players. But being a market maker, I had excellent insight into Saudi capital flows. That local knowledge was our edge. We weren't trying to compete on euro-dollar with JP Morgan. We were focused on where we had an information advantage. Being embedded in this market allowed for a certain amount of proprietary positioning. One more thing about banks. Culture matters. Some banks run tight risk limits and operate as pure flow businesses, match buyers and sellers, take the spread, don't hold positions. When I was at Shuei Capital building their treasury function, we acted more as a quasi-corporate, and consequently taking risk positions would have been inappropriate, and we tended to cover our positions back to back. But here's what hasn't changed. Banks are the infrastructure of the FX market. Every corporate hedging program, every asset manager's currency overlay, every central bank intervention, it all goes through banks. Understanding how they operate, what they're optimizing for, and where they make money helps you navigate your own interactions with them. Now let's talk about corporates, because this is probably the most important category for most people listening. Corporates trade FX because they have to, not because they want to. They're manufacturers, exporters, importers, multinationals with operations across borders. FX risk is a byproduct of their real business. Their goal is to manage that risk, not to profit from it. Let me give you a concrete example. Toyota manufactures cars in Japan, sells them in the United States, and receives payment in dollars. Those dollar revenues need to be converted back to yen to pay Japanese suppliers and shareholders. If the yen strengthens against the dollar, Toyota's profit margins get squeezed, so they hedge. How? Forward contracts. Lock in the rate today for dollars they'll receive in 3 months, 6 months, 12 months. That eliminates the uncertainty. They know what exchange rate they're getting, they can plan accordingly, and the Treasury team has done its job: protect the business from FX volatility. But here's where it gets interesting. Corporates are natural hedgers. They're not trying to time the market. They're not speculating. They have a consistent direction based on their business flows. An exporter receiving foreign currency is a natural seller. An importer paying foreign suppliers is a natural buyer. Banks know this. And good corporate treasurers know that banks know this. So part of the game is managing that information asymmetry. If your bank knows you're going to be a seller of 10 million euros every month like clockwork, they can position themselves accordingly. Maybe you get slightly worse pricing because your flow is predictable. The sophisticated treasurers handle this by spreading their business across multiple banks, varying the timing of their hedges, and occasionally not hedging at all to keep the market guessing. It's a chess game. I worked with a corporate client once, won't name them, who had massive dollar receivables. They had a policy of hedging everything immediately, religiously. Every invoice hedged the day it was booked. Their bank knew this. And I'm quite certain they were getting worse pricing because their behaviour was entirely predictable. We convinced them to introduce some flexibility. Layer the hedges over a few days, vary the tenors, use options occasionally instead of forwards. Nothing dramatic, but enough to make their flow less transparent. Their execution costs improve noticeably. Another point about corporates. There's often a disconnect between what Treasury should be doing and what senior management thinks they should be doing. I've seen companies treat Treasury like a profit center, encouraging them to take views on currencies, trying to time the market, essentially speculating with FX positions. This is almost always a mistake. Corporate treasurers are not currency traders. They don't have the infrastructure, the information flow, or frankly the mandate to be speculating in FX. When corporates try to be clever with currency positioning, they usually lose money. And even when they make money, it's a distraction from what they should be focused on, running their actual business. The best corporate treasurers I've worked with have clear hedging policies, execute them consistently, measure their performance against those policies rather than against market movements, and explain to senior management why not hedging is often riskier than the cost of hedging. That last point is important. Hedging costs money. Forward points, option premiums, bid-offer spreads. Management sees that cost and sometimes questions whether it's worth it. The treasurer's job is to explain that the cost of hedging is insurance against volatility that could be far more expensive. Asset managers and hedge funds are different animals entirely. Asset managers running global portfolios have currency exposure, whether they want it or not. If you're a US-based fund investing in European equities, you've got euro exposure. If those stocks go up 10% but the euro falls 10% against the dollar, you've made nothing. Currency can dominate returns. Some asset managers hedge this currency risk. They use currency overlay programs, essentially hedging strategies that sit on top of the underlying investments. Others leave it unhedged, arguing that over the long term, currency movements net out. There's no universal right answer. It depends on the fund's mandate and risk tolerance. But when asset managers do hedge, they're typically operating at scale. A large pension fund might have billions in foreign currency exposure. Those hedging flows are significant and can move markets, especially in less liquid currency pairs. Hedge funds are different. They're actively trying to profit from currency movements. Macro funds in particular take large directional positions based on economic views. George Soros breaking the Bank of England in 1992 is the famous example, but macro funds are still active today. Then you have carry trades. This is where funds borrow in low-yielding currencies and invest in high-yielding currencies, pocketing the interest rate differential. It works beautifully until it doesn't. When volatility spikes and everyone tries to unwind carry trades simultaneously, you get dramatic moves. The yen is often the funding currency for carry trades, which is why you sometimes see explosive yen rallies when risk appetite collapses. High-frequency trading firms are another category. They're not taking directional views. They're arbitraging tiny price discrepancies across platforms, making markets, and scalping fractions of pips on massive volume. I don't have direct experience with HFT, that came after my time on the dealing desk, but their impact on market microstructure is significant. They provide liquidity, but they also pull it instantly when conditions deteriorate. The key thing about asset managers and hedge funds is that their flows are less predictable than corporates. A corporate has natural hedging needs. An asset manager or hedge fund is making active decisions based on market views. That makes them both more interesting counterparties and potentially more dangerous if you're on the wrong side of their positioning. Central banks are the elephants in the room. They operate in FX markets for two main reasons: reserve management and intervention. Reserve management is straightforward. Central banks hold foreign currency reserves, typically dollars, euros, yen, as part of their national balance sheet. They need to invest those reserves, which means they're in the market buying and selling bonds, managing liquidity, doing FX swaps. The volumes are enormous, but the trades are usually predictable and not market moving. Intervention is different. That's when a central bank actively buys or sells currency to influence the exchange rate. This can be overt, the central bank announces what it's doing, or covert, operating through intermediaries to mask its activity. Or, as I witnessed while in Riyadh, the market constantly speculated that the pegged rial must devalue as the oil price jumped around, believing there was some synergy. But the central bank, SAMA, stayed silent and maintained the price, causing many participants to regret what they thought was a hedge against the movement in oil. Knowing SAMA's attitude to speculators interfering in the market was an advantage to those in the know. In floating currency regimes, intervention is less common but more dramatic when it happens. The Swiss National Bank defending the franc floor in 2015, the Bank of Japan intervening to weaken the yen. These operations can involve tens of billions of dollars in a single day. The challenge for central banks is that markets are bigger than they are. Even the largest central banks can't fight sustained market pressure indefinitely. They have finite reserves. If the market is convinced a currency is overvalued and should weaken, no amount of central bank intervention will hold it permanently. Britain learned that in 1992 when Soros bet against the pound. Central banks also provide liquidity during crises through swap lines. When dollar funding dried up in 2008, the Federal Reserve opened swap lines with other central banks, allowing them to borrow dollars and lend them to their domestic banks. Same thing happened in 2020 during the COVID panic. These aren't market trades, but they're massive flows that affect FX markets indirectly. From a practitioner's perspective, central bank activity is both a risk and an opportunity. If you're caught on the wrong side of intervention, it's painful. But if you understand a central bank's objectives and can position accordingly, there's profit to be made. Just don't bet against a central bank that has the ammunition and political will to defend its position. That's expensive education. So why does all this matter? Why spend 20 minutes talking about who's in the market? Because flows move prices, and understanding who's generating those flows helps you understand why prices are moving. If I'm at my desk and I see heavy dollar demand against yen from corporates, that tells me something. Real money is flowing. There's underlying business driving this. That's different from seeing hedge fund positioning in the same direction. One is sustainable, driven by fundamentals. The other might reverse quickly if sentiment shifts. If I know central banks are likely to intervene at certain levels, I can structure my risk accordingly, not fighting them, but positioning to benefit when they do act. If I understand that my corporate clients have predictable hedging needs, I can provide better pricing because I can manage my risk more efficiently. The best traders I knew weren't necessarily the ones with the most sophisticated models or the fastest reflexes. They were the ones who understood participant behavior. They knew their clients. They could read the flow. They understood why the market was moving, not just that it was moving. That's pattern recognition built over years. But you start building it by understanding the basics. Who's in the market? What they're trying to achieve? How their objectives differ? And how those differences create the flows that drive prices. That's the landscape of FX market participants. Banks providing liquidity and taking risk. Corporates hedging commercial flows. Asset managers and hedge funds pursuing returns. Central banks managing reserves and intervening when necessary. Different objectives, different time horizons, different risk tolerances, all operating in the same market simultaneously. Next episode, we'll get practical. We're going to talk about spot FX trading, the mechanics of how transactions actually work, value dates, settlement, the T+2 convention, how spot rates are quoted and what affects pricing, the foundation that everything else builds on. I'm David Axtell. Thank you for joining me on the trading floor. If you're finding this useful, subscribe wherever you get your podcasts. And if you want the comprehensive treatment, FX Cash Products, the book Luigi Rondinini and I wrote, will cover all of this with the depth practitioners need. Soon available through Rondinini Publishing. See you in episode 4.